Let's bring in Jeremy Bryan, portfolio manager at Gradient Investments, and our own Mike Santoli, CNBC senior markets commentator. Mike, let me ask you first. I mean, the market must like the fact that the economy seems strong and the recession scenario increasingly seems to be getting off the table, but it can't love the fact that so many companies are issuing warnings.
No, for sure, Tyler. I think CEOs, first of all, are seeing a little bit of a mixed bag depending on the sector they're in. It's a very noisy earnings season, as it typically is, and also really no benefit from their perspective to overpromise this year, not really knowing if we're going to get the economic slowdown that everybody still plugs into their models, whether we've seen evidence of it so far or not. We are still beating at an 80% rate the earnings forecast, so that's pretty typical at this time of the year. The absolute growth rate, not wonderful, but probably still tracking for low single digits year over year. Sales growth has been harder to come by. So I think that explains part of the hesitation among companies to really extrapolate better numbers for the next few quarters.
So, Jeremy, do we have the economy we have is the economy we've got? But do we have the economy that the market wants, and particularly in light of the fact that quite a few companies have either dialed back their forecasts or warned?
Yeah, I still think we do. I think this is not abnormal, right? Is that you come into earnings season in January, you have lofty expectations of earnings. It was over 11% was the consensus for 2024, and companies come out and say, well, we're gonna lower that bar a little bit for the hopes that we exceed it in future quarters. It happens every year. It's something that we actually become relatively accustomed to. It's a silly game sometimes that we play. But at the end of the day, we still believe that GDP numbers are there, jobs are still there, growth is still happening. So there's still a lot of positive things with regard to the economy. I think just expectations coming into the year were just a little overinflated, and we're starting to normalize that now. A mid to high single digit earnings is probably more accurate than double digit earnings anyway. And in that case, if we still get there, we still have a good backdrop for the stocks to work in 2024.
Mike, do you think that that the analysts had maybe shrugged off the labor costs that we've seen, and we've seen some big union contracts coming in at historic rates, and also things like, we heard J.B. Hunt, I mentioned it yesterday, talking about how much of a hit they're taking because of insurance costs. I know companies are going to be seeing those costs increase in their directors and officers insurance and their property and casualty lines. I mean, is it that the analysts, when they're putting their expectations out, have been sort of missing the mark on what these big cost inputs are?
I'm sure it's more about not having enough granular detail about whether the disinflationary trend in the overall economy on the headline and core numbers are applicable company by company, sector by sector, and you have to have a reality check on margins as you report. I think one other thing we might be seeing is, the first couple of weeks of earnings season, you have a certain sampling of industries, financials, and then you get a little more consumer. We have a very top-heavy stock market right now. The performance has been concentrated among the massive companies. That's also where most of the earnings growth is concentrated, and we have not really gotten the reports from there yet. So I think it's an uneven corporate profit picture. We definitely seem to have troughed in terms of the overall earnings rate, but it's not clear sailing to get back to peak margins for most companies. We're going to still rely on some of the huge mega cap growth names to make the full S&P 500 targets.
Two of the companies, Jeremy, that you like, Procter Gamble and Raytheon. You also like Constellation Brands, by the way, all of which you think can continue to grow. They, however, were on that list of companies that had issued warnings about profitability. How do you? So I have to assume then that Procter Gamble and Raytheon, you think, are going to be able to step past whatever short-term issues they face.
Absolutely. So from a Procter & Gamble's perspective, let's start there, is that organic growth was actually higher than expected in the quarter, and their guidance was relatively strong in that regard. And I think that's why it had a positive reaction to even what was considered maybe slightly weak guidance. And again, this is coming on, we're bringing numbers down a bit, but overall, we're not moving this thing much. And they're still talking about a relatively robust and resilient consumer. So there is still plenty of activity there, and they're weathering that storm of inflation that everybody was worried about, that pricing was going to come down substantially, or that people were going to pivot away from their products. I think that at least this quarter was somewhat put to rest. Then on the Raytheon side, it's much more an argument around real self-inflicted wounds that happened last year with regard to repairing some of the airplanes and the issues that they had there coming closer to an end, and the core business being still relatively strong. So even if their guidance wasn't robust and didn't significantly surprise to the upside, there's still a lot of health within the companies that are giving people confidence that things aren't falling off a cliff.
All right, Jeremy, we should point out that Jeremy personally owns Constellation and Raytheon. Jeremy Bryan, thank you very much. Mike Santoli, thanks to you as well.